This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 7, 2026, and this is the New York pre-market. Now, let's get into it. The VIX is sitting at a complacent 15.81, but look closer at the tape. Energy is surging while technology bleeds out. We're seeing a market structure that is quietly unraveling right before the single most important data point of the quarter hits the desk. The calendar is stark today. Friday, August 7th, brings the Non-Farm Payrolls report. This is the litmus test for the labor market and the primary driver for volatility in the coming sessions. There are no other central bank decisions or major earnings reports in the immediate window that outweigh this data. We are entirely dependent on whether the labor market holds up or fractures.
And what we watch for isn't just the headline number but the reaction. If the jobs data misses consensus, that 15.81 VIX reading won't last long. The yield curve is flat, inflation is sticky at 3.29%, and the Fed has nowhere to hide. A miss here doesn't just hurt sentiment, it removes the soft landing narrative entirely.
Let's look at the opening snapshot as of 9:19 ET. The broad market is retreating. The S&P 500 SPY is down minus 0.16% to $768.56, hovering just below yesterday's high of $771.82. The Nasdaq QQQ is weaker at $714.65, off minus 0.37%, pulling back from its 10-day high of $728.54. The Dow Diamonds is down minus 0.85% to $538.19, and small caps Russell 2000 IWM are down minus 0.51% to $298.25. But there is one glaring exception. Energy, the technology sector, is up plus 1.48% to $58.16, standing alone in the green.
That isolation is the story. You have the entire market structure leaning south: tech, industrials, consumer discretionary, all red, while energy acts as a solitary island of strength. That isn't just rotation, that is a defense mechanism kicking in.
We are seeing high conviction movement in individual names, particularly in the cloud and materials sectors. Cloudflare NET has gapped up plus 14.6% to $326, following a Barclays price target raised to $355. Meanwhile, MP Materials MP is up plus 6.2% to $50.45 on strong Q2 sales highlights. On the flip side, Under Armour UAA is crashing minus 6.4% to $5.99 after missing earnings estimates completely. Look at the sentiment bleed on UAA. An earnings per share miss of 0 and a revenue miss sends that stock down nearly 7% pre-open. That tells me the market is no longer forgiving of operational failures. When you combine that with the bearish sentiment scores on JPM and AMD, we aren't seeing greed. We are seeing a ruthless clearing of weak hands. The crowd is pruning the portfolio, not building it.
It's a bifurcation. NET and MP are moving on specific, verified catalysts, Barclays upgrades and record NdPr sales. These are fundamental drivers, but UAA is collapsing on basic execution errors. The message is simple. In this environment, you need a reason to be long. You can't just rely on brand recognition anymore. The gap-ups in NET and MP are supported by new price targets and supply chain narratives, whereas UAA has nothing left to trade on.
But let's not confuse a tactical bounce with a trend reversal. The energy sector is up plus 1.48%, sure, but that sector is down minus 1.36% for the week. And look at the macro backdrop. Core PCE is 3.29%. We are paying a premium for energy while the broader consumption engine, represented by UAA, and the broader consumer discretionary sector, down minus 0.46%, is stalling. The risk here is that the flight to safety is actually a flight out of equity risk altogether, disguised as a sector play.
Let's drill into the technicals of the S&P 500 ETF SPY. It's currently at $768.56, down minus 0.16%. It's testing the upper quartile of its 10-day range, which spans from $729.10 to $776.85. Immediate resistance is at yesterday's high of $771.82, but the more critical support line is yesterday's low of $767.46.
Technically, this is a distribution phase. SPY closed yesterday below $770 and hasn't reclaimed it. The resistance at $771.82 is hard. If we fail to break that, the path of least resistance is down to $760.52, which was the low on August 4th. The volume profile suggests there are no buyers willing to step in above $770. We are seeing a slow bleed, not a panic sell-off, which makes it trickier. Once $767.46 goes, algorithmic selling likely accelerates toward that $760 zone.
And remember, grid, you're looking at price action, but the fuel tank is empty. The 10-year yield is at 4.63% with a flat curve spread of plus 0.44 pp. That flat curve is historically toxic for equity valuations. You can talk about $760 support, but if non-farm payrolls misses and the curve steepens violently, technical levels become suggestions. The VIX at 15.81 is a lie. It's suppressing the true cost of risk. When the non-farm payrolls data drops, the repricing could bypass $760 entirely.
I'm not arguing against the macro risk SPECTER. I'm describing the mechanics. The triple Q is even more telling. It pulled back from $728.54 to $714.65. Support there is $708.50. If SPY breaks $767.46, triple Q will likely tag $708.50 within hours. The correlation is tight. The technical damage in the megacap space is already done. The question is how fast the capitulation happens.
Which brings us back to the silence. The VIX dropped 0.69 points to 15.81. Why is volatility compressing while prices are drifting lower? That is the definition of complacency. Usually, if money is leaving the market, implied vol should creep up. Here, traders are refusing to hedge. They are hoping Friday's data saves them. That is a fragile posture. If the market believes the soft landing is intact despite the earnings misses in JPM and AMD, then yes, $760 might hold. But if the mood shifts, that low VIX means there are no bids waiting. It's a vacuum. Let's look at the standout performer, the technology sector energy. It's up plus 1.48% to $58.16. Contrast that with the technology sector technology at minus 0.31% to $185.33, and consumer discretionary at minus 0.46% to $118.10. We are seeing a massive divergence.
This isn't random. Look at MP Materials, up plus 6.2% to $50.45. Why? Record NdPr sales. This is a strategic supply chain narrative tied to geopolitical tension. It's not just oil is up, it's that capital is moving into tangible, scarce resources. Conversely, tech is getting hammered by valuation concerns, with the 10-year at 4.63%. High multiple growth stocks suffer from discounting future cash flows. The flow data supports this. We are seeing heavy interest in MP and FSLR, while NVDA and AMD are seeing neutral to negative sentiment. It's a rotation from software/logic to hardware/resources.
Chart-wise, the energy sector is the only thing holding structure, while the industrial sector industrials is down minus 0.85% to $184.76. The energy sector is pushing higher. This inverse relationship is key. As long as the energy sector rises, it's siphoning liquidity from the other sectors. The energy sector/SPY ratio is effectively acting as a barometer for risk appetite. When that ratio ticks up, tech gets crushed. Right now, the ratio is climbing aggressively. Technically, this suggests the hedge trade is crowded. Everyone knows they are supposed to be in energy right now. That creates a fragility. If the geopolitical premium fades, that capital has to go somewhere, and it's unlikely to go back into underperforming tech immediately.
Crowded trades are dangerous. You have everyone piling into energy as a hedge, but look at the weekly context. The energy sector is down minus 1.36% for the week. Today's plus 1.48% gain is a bounce, not a trend change. And consider the inflation backdrop. Core PCE is 3.29%. If oil keeps rising, that inflation data gets worse, which keeps the Fed hawkish, which hurts the economy. So, by hedging in energy, you are inadvertently hedging against the very economic growth you want. It's a self-reinforcing loop of weakness elsewhere. I'd be wary of chasing the energy sector here. The risk/reward skew is terrible.
Let's isolate two specific names that define the current market dichotomy: Cloudflare NET and Under Armour UAA. NET is up plus 14.6% to $326. UAA is down minus 6.4% to $5.99.
These are perfect case studies for fundamental verification. NET is up 14.6% because Barclays raised the PT to $355. That is external validator confirming the thesis. Compare that to UAA, which is down 6.4% because they missed earnings per share and revenue. The market is rewarding validated optimism and punishing unverified hope. If you look at the broader list, CART is also up plus 14.1% on an upgrade. The common thread is the analyst note. In this environment, Wall Street's stamp of approval is the only currency that matters. Without it, stocks like UAA get bid down regardless of their historical brand strength.
And look at the sentiment score. UAA is effectively dead money. The fear around consumer discretionary is palpable. Consumer discretionary is down minus 0.46% today. Traders are scared of spending data. If UAA can't sell product at a profit, what happens to the retailer 3 months later? The sentiment drag on consumer discretionary is severe. Retailers are essentially being punished for inflation passing through to consumers. Net, however, is B2B. Their clients pay fees regardless of consumer spending habits. That defensibility is why the sentiment is so strongly bullish on NET versus the visceral hate for UAA.
But don't forget the gap risk. NET gapping up 14.6% sets a high bar. If tonight's volume doesn't sustain that price, we'll see mean reversion. And regarding UAA, at $5.99, we are approaching psychological support. If it breaks $6, we could see accelerated selling as stop losses trigger. The risk on the long side of NET is exhaustion. The risk on the short side of UAA is a dead cat bounce. Both are volatile. Neither offers safety.
Finally, let's address the nerve center of this market, Triple Q. It's at $714.65, down minus 0.37%. It has pulled back from its 10-day high of $728.54. Support is at $708.50, with a secondary floor at $700.07, the August 3rd close.
The breakdown from $728.54 is significant. That high represented the peak of the recent momentum wave. Breaking below $719.32, yesterday's high, confirms the correction is underway. We are now testing $714.65. If $708.50 fails, we open the door to $700.07. Note the shape, it's a descending triangle. Lower highs roughly equal lows. That is a bearish continuation pattern. Unless we reclaim $720 with volume, the technical bias is firmly downward.
And fundamentally, the heavyweights are mixed. NVDA is up plus 0.2%, but AMD is down minus 0.5%. Google is up plus 0.33%, but NFLX is down minus 0.27%. There is no unified leader. In a bull market, you have one or two stocks carrying the index. Here, the load-bearing capacity is distributed poorly. NVDA is trying to hold the line, but it's fighting against the broader macro headwinds of a flat yield curve. Without a clear winner, Triple Q is vulnerable to any negative macro shock.
Retail sentiment on tech is turning cautious. The gap ups in smaller caps like MCHP and CART are distracting, but the big boys, Opal, MSFT, are barely moving. Opal is up plus 0.33%. MSFT is up plus 0.35%. They are stagnant. Stagnation in the megacaps while energy runs is a classic sign of institutional rotation. They are trimming tech exposure to fund the energy hedge. That reduces the bid support for triple Q. If institutions stop buying dips in Apple and Microsoft, the $700 support becomes much harder to defend.
So we have a triple Q that is technically broken below its recent high, fundamentally lacking a clear leader and sentimentally weighed down by institutional rotation. The only thing keeping it from crashing through $700 is the general complacency of the VIX. But that VIX is a ticking clock. If non-farm payrolls comes in weak, triple Q could see a rapid expansion of volatility. The cost of protection is cheap right now. Waiting for confirmation is expensive.
Let's tie this together. Grid has outlined a technical breakdown in SPY and triple Q, with key support lines at $760.52 and $700.07 respectively, signaling that price action is weakening. CIPHER confirms that the fundamental driver behind the market's hesitation is a lack of broad-based earnings quality. We have specific winners like NET driven by upgrades, but losers like UAA exposing operational risks. Meanwhile, Pulse notes that the VIX suppression at 15.81 indicates a complacent crowd that is refusing to hedge, believing the soft landing narrative still holds despite the JPM and AMD sentiment drags. SPECTER warns that this complacency is the primary risk, that a weak non-farm payrolls print will instantly invalidate these technical levels and force a volatility spike. The consensus is clear. The market is fragile, supported by energy hedges but fundamentally hollow.
To wrap up our pre-market analysis. First, the VIX at 15.81 is masking significant structural weakness in SPY and triple Q. Second, the market is bifurcating between validated catalysts like NET and failing fundamentals like UAA. Third, all eyes are on Friday's non-farm payrolls report, which will determine if this complacency turns into chaos. Thank you for listening to the ShadowQuant Equities edition. We'll see you at the open. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.